building the tax bracket. Prior to that, I was senior tax counsel for 3 years. Appreciate the opportunity to today and introduce Reid, but we're agendas. We're going to talk through kind of tax structuring, what the seller and buyer's objectives are from a tax perspective. Then give a bit of an economic and legislative update.
Quick intro, Reid Johnston, director in the tax practice, specialized really in M&A transactional. So we work closely with financial accounting teams, doing diligence and other structure. Answering questions. Is there a way? Do we have a clicker?
Looks like I'm going to be running that. So hold on one second.
Yeah, so we're really just going to talk through some of the basic, what we think about when we're doing deals, really from a tax standpoint. So, Dominic, as many questions or any.
Oh, sorry. One second
No
here.
problem.
I think I got 2 of these open here. There we go.
So basically, when we're going through a deal from, a tax, we really want to sort of step back and think about, well, what's the tax classification? It's funny how often people don't know this, whether you're on the buy side or the sell side. You ask the team, or they'll ask, they want to go first question is, well, what's on it? And sometimes it can take days for somebody to find out. Each different entity, whether it's a partnership, S corp, has different tax implications for the buyer, for the seller, and so you want to think about, if you're on the buy side, what is your structure? Is it set up where it's mainly partnerships, or is it set up as a consolidated group? And that sort of drives the deal from a tax. So yeah, who are the parties? So, how is the buyer set up? Then you start to want to think through, how is the transaction going to be structured? You want to purchase equity? Do you want to purchase stock? Just assets, which we're going to go through piece by piece, but they have very different tax ramifications. Sometimes purchase or merger can be tax-free versus taxable, just depending on. A lot of what we see these days is reps and warranties insurance. So a lot of buyers go out and ensure that the seller what they're telling them is true. And the first thing reps and warranties provider is going to want is to see the tax diligence report. So a lot of times they bring us in just to make sure that everything's clean from what we're looking at. So the insurer.
Overall, yeah, 2 kind of primary things we're looking for, why it matters. The seller typically wants to sell it. The buyer generally wants to buy assets. The seller generally wants to sell stock. We have the opportunity for 2 reasons. One, all the liabilities go, and it's a simple transaction, kind of go through it. Buyer wants to buy assets.
You're ruining my later slides.
Oh, sorry. So anyway, at a 30,000 foot view, those are the 2 primary things.
Right.
Go into the rest.
And we'll touch. But you're absolutely. This slide here, it really just shows some of the details around the different entity types. Really, the important thing to note here is, for an S corporation or a LLC, those are flow through entities. So any income losses, items of gain, they flow through, they're taxed at the shareholder. They're not taxed. Whereas the C corporation carries that corporate tax, and any distributions are also taxed at the shareholder level. So it's double taxation. Whereas like a buyer's typically not going to want two levels. I think there's move on. Again, this is just showing sort of what type of transactions are available for whether the target, what the target corporation is. So if it's a C corporation, do a stock deal, great asset deal. 338 election, which I will get into later, you can do if it's a subsidiary.
You can do a 338. What's the tax structure?
And I don't know, do you know the
Yeah.
reasoning behind it?
Yeah, so if you're a subsidiary of a top tier corporation and all of the assets, operations are consolidated. So it's making the election for that lower tier, you can do that as an asset deal. But if you do it at the upper level of the corporation, you're going to avoid tax. They give it around. Okay, but S corp receive tax structure. So you're getting the same the security context, the same answer, as long as that they still
Okay, so it's an IRS regulation. So now C corporation has a double. We're not going to give that up. Got it.
Yeah.
Got it.
Yeah, for S corporation, everything's allowed. One thing that we'll sort of touch on, but what's important when doing a deal with the S corporation, probably the most important thing is to confirm it's a valid S corp. There's a lot of qualifications that go in there, and it's things that can easily be missed. An LLC, typically a partnership, you purchase the partnership interest. You can purchase the assets directly. A lot of times, a purchase of partnership interest is for tax purposes. And you can also do equity orders, which touch.
I don't know, like, Reid, how many of your deals would you say with S corp specific?
It's more of, do they have the documentation? A lot of times they'll form this 10, 20 years ago, they'll sign the election and then they'll file it. And, if it was long enough ago where they don't have everything in an electronic file somewhere. And, we ask them the questions and they're like, yeah, we think we remember doing that, but sometimes it's hard to confirm, and we have to either tell our client, who a lot of times is the buyer, there is a risk here, but there are ways to mitigate it. Get a transcript from the IRS, which say, okay, this has been
Or reps worries.
will they carve out at the S corp community? Not as much, because you're trying to do a 338 deal or an F reorg, and it's not a valid S corp, do those. So if you're carving. So stock deals, probably the easiest type of deal. Not always the most common. Buyer pays cash for stock straight to the shareholders, so the shareholders pay single tax. Then the buyer owns the company right out, pretty much just stepping into the shoes of the old shareholders. So the company there's no revaluation of assets, there's no step up in basis. The buyer will have basis rather than a step up. Sellers typically prefer have one level of tax, but then a lot of times buyers own a corporation which may not fit in their structure. Next slide, this really just shows the advantages of and disadvantages. I mentioned a couple of them, and I think the advantage buyer is well, leverage over purchase price and carry over in the basis of assets isn't necessarily an advantage, but you don't have to come in and have everything value. So the assets the same basis. Disadvantages, you get everything, all the assets, all the liabilities, whether you want thing or not. And there's no step up, there's no later amortization. So you don't get that tax shield. Why the sellers want this is it avoids double taxation. Get rid of all the undesired assets and liabilities.
You guys ever see transactions where you do a stock deal, but then kind of paper it like you also the sellers just kind of through some indemnification mechanisms just for a bunch of liabilities you generally see them.
Well, I mean, there are some times that they'll distribute out unwanted assets or liabilities, but I think what you're talking about is really a 338.
I'm talking about contract side of legal.
Where you do see some of that, in very limited circumstances. Unless you're a company, the name is so attached to it that they really own the company. You can make a payment to the individual seller, which is kind of an asset. Stock. That's pretty much the only way to get out. One advantage
is that in a stock deal, you get all the tax attributes of business. So a lot of times, a large amount of net operating losses that you can take on and offset income. There are typically limitations. Section 382, that could be half a glass a day. So
basically, you can't market in losses. Like when you're building.
The IRS wants to stop you from buying a company that has $100 million in losses for $1 million and then getting the tax benefit of that $100 million. So the 338 legal, it is built up. There's a couple of sort of qualifications. The buyer needs to acquire 80%, and both the buyer and seller. So typically, if a seller is going to agree to this, they have a higher tax liability at the end of the because it's an asset purchase. So they're going to create some ordinary income from the sale of assets as well as capital gain, whereas it's just stock. That's capital gain at reduced rates.
Yeah. This becomes a deal. Seller sells into the stock deal. That's fine. Increase the price. Tax benefit.
Do you see most transactions where you guys where the buyer agrees to versa?
We do, and we help estimate what we think the growth is going to be. advise the buyer, this is what we think it should be. Back huge number and try to poke at it.
You ever seen any deals where the buyer will just say, hey, I'm going to offer you $10 million for your company. Our offer assumes a 338.
Yep.
So it's just, hey, I'm doing a 338. This is your price. Got it. Right.
And if they don't want it, then we can figure out how much down. Yeah, I think the next slide, really advantages, disadvantages, for the buyer, it's assets. So they get up in the basis of assets. And, disadvantage, if there are any tax attributes, NOLs, they go away. They don't. Seller advantages. So it's still there's still 2 layers of tax, but since it's a deemed asset sale of the target company, there's a tax there on the sale of the assets. Then the target, then that company liquidates. But typically, because there's the first tax, the liquidation is.
For a math problem, right? Be the case on flow through entities, it can occur and they're
Run into recently. Arthur, because there's a difference.
not usually material.
So asset deals, I mean, very basic. Buyer pays the target company for I mean, the main advantage, same as the 338, is that you can set up tax basis, you can amortize any excess as there can be higher legal fees. Contracts have to be renegotiated. You're buying the operating assets business, but a lot of contracts with buyer, I guess, vendors or customers of that business are with the former business, not with. Seller advantages, disadvantages. Really, the only advantage for the seller is they have more leverage over price. Disadvantage, they're liable to have a tax debt.
We do see negotiations around that price. Like this issue, the buyer, the seller allocate items to capital gain assets like goodwill, things of that nature. Anything that's allocated to PPV, for example, generally recast for the income, so you get the rate arbitrage. The buyer wants those allocated to PPV, expensive right now under 3 or 4 years. It's an immediate write-off. So you'll have some negotiation around generally in the asset purchase agreement, in the body or something.
Maybe you're going to cover this later, but did the buyer and seller have to agree on the purchase price allocation?
You don't, you have to check or we did, and it was included or it wasn't. There's a rumor that the IRS matches things up. You know, maybe they have in the past. I've been doing this for 20-something years. I've never seen it. I've never had an audit come up. It's called 8594. I've never had an 8594 come up. So we've been in situations where like just gonna agree to disagree. You go do your thing, we'll do our thing, and if it comes up, we'll fight it, or we're not gonna talk to you about it.
But who is there? The lawyers start to talk about indemnification language if wants to kind of drive the bus there, but or you want to sellers, or you do the indemnification.
It generally doesn't rise to level of estimate.
Most of the purchase agreements I see have with the buyer and seller.
Yeah,
To that seems pretty standard. But I have run into a lot of times where there's substantial transaction costs. And a lot of transaction costs sort of gets capitalized or considered purchase price for the buyer, but not for the seller. So when they fill out those 9594s, they're different because the buyer allocates a higher amount. Say, if they pay, they're going to have $5 million. Right. Yep. So partnership interest, very common. The RV corporation partnership, so already in flow through, something we see a lot of private equity funds, how their structures are set up. So having by that, typically treated like an asset deal. They need to make sure that there's a 754 election made, which revalues an asset, just so the buyer can still get additional amortization.
One trap for the unwary, where you're moving further away from it, prohibit related parties selling tables back and forth and it changes the related party status to 20% ownership. So you see this come up a lot on rollovers, where you own a partnership, you want to transfer part of your interest into the acquiring entity. Anytime that starts encroaching the 20% number, we're looking to see if there were any tangibles in place back in 1993, so very small. So we're moving away from it. But anytime you do a deal, there's an equity rollover around 20%, could get to 20%. It's important. And organize the transaction steps in a way. Once you get the rollover, you're the 20%, now you're related parties. The acquisition is no more.
Yeah, and that does typically one thing about partnerships that may need to be wary of is the Bipartisan Budget Act of 2015 changed the way the IRS can come after partnerships. It used to be if the IRS thought there was a, they would have to go after them, and sometimes going after hundreds of individual partners to collect, extra taxes. Too much paperwork, and now they can go. They can assess the tax at the partner level. So if you're a buyer coming in and you buy that, you want to make sure there are ways that you can elect out of that partnership regime, or you can put into partnership agreement to push out elections to the former partners, which is typically one or both of those are things we recommend on any deal of partnership interest. As a buyer, you don't want to take on extra successor liability. So effort organizations, I won't spend too much time, or I won't get into it in too much detail unless somebody asks specific questions. We see this a lot in S Corps because an S Corp has a lot of qualifications that make it an S Corp. A buyer may be worried that they missed something. It may not be a valid S Corp. So they have the seller undergo every organization with at a high level, the selling shareholders form a new company, elect for that to be an S Corp, sure that everything's right. Then the next day they drop all assets, the old S Corp, into it, and check the box, elect to be an LLC for tax reasons, is deemed liquidation, and then buy the LLC interest. So at the end of the day, they're buying assets. But it's a lot of steps that you need to go through. There's specific timing, like waste, paper, everything. But it sort of cleans up the historic S corp. It doesn't necessarily get rid of all successor liabilities, but it's a lot worried.
Is that the primary reason for an F corp? You're doing acquisition? Right, I'm
For
an
an
F.
For reorg, we see it a lot in S corps. It can be done. Other
Like 351 or corporate transactions where there's busting the that. They'll do a kind of transaction several mergers that affect change in form and nature. Looks like a statutory A or B type of reorganization. In fact, it's just times in my career it happens, not very frequently. This is
so advantages for the buyer, they get that validity is less, but like I said, the timing of everything, making sure that everything's correct. I mean, for the ability, they can have a role.
I usually just like touch on these just in the interest of time. So we're about 30 minutes now. We have
Okay.
40 minutes. I'm happy to stick around and talk text. People are studying to us.
Yeah. Normally I see it. Science class. Doing good. So just typical issues. I mean, really what you want to worry about from a buy side is success. So it over in different ways. C corporation is going to have no success. It's going to include federal, state income taxes and sales use taxes, property, payroll, SG. But there are other things to consider in these specific areas. Corporations, I think I touched on it earlier. You do get the attributes subject to the limitation, but then you do need to still make sure that the income is correct. Whereas for the S corporation, that income is at the recognized to the shareholder. So you're not as in doing due diligence. I think, like I've said, S corporations, the most important thing is S corp. If anything was not correct, the election wasn't filed correctly, one of their shareholders, valid shareholder, weren't a U.S. citizen, or they weren't a certain type of trust, then it blows up the S corp, and the IRS can say, well, it's been a C corp. It's in U.S. That partnerships, the partnership audit rules are important. Just to make sure that that's communicated in their sometimes, a lot of times we see partners classified as employees where they get one and they're distributed, but they're also on payroll, or maybe they get some sort of fringe benefit that goes through a W-2. That's an issue.
Can't be both. You're going to report income. There are structures in place where you employ a lower tier partnership with a partnership. That's IRS pushback on that. It's worked its way through so far. One way around it.
Okay, well, I'll try to be fast, but this is a big area we see all the time. And there was this Supreme Court decision in 2018 that if you know Wayfair, the online retailer, state of South Dakota said, well, you're selling all this stuff in the state. We're not getting sales tax. So the court decided that it could assess sales tax. Typically, or historically, the company had to have a physical presence in the state, like people, location. And so before that, if the company didn't have physical presence, they could sell stuff anywhere across state lines and not get taxed. After this, after South Dakota did it, every state is jumping on this, saying, well, there's all these online sellers stuff everywhere. So they're starting to charge sales tax. And it's changing so much. States are catching up that companies are having a hard time keeping up with it, particularly smaller growing companies. This is an area in just about every diligence we do that there's some sort of exposure here. Most states, or generally states, say if you sell 100,000 or more, we're going to come after you for sales tax. So below that threshold, might be okay, but I mean it's constantly changing, and states trying to keep up can change their own laws and may not know about it. And in the next one, this is similar along the same lines, what they call a marketplace facilitator. So if you notice in the past couple of years, everything you buy on Amazon started sales tax. They didn't have to do that before this. So yeah, now all those online retailers selling a product that somebody else is just going through the online retailer. Also,
Other than states catching up, you guys see any trends
on the sales tax? I mean, they're all sort of putting in these rules for online sales. A lot of like software and digital sales we're seeing as well. Like software as a service, or sorry, a lot of times services are taxed by a state. So a lot of companies would go to a website and say, well, that's a service, so there's no sales tax. So now you're writing in, well, that's software. We think of it differently. So that's one area. But yeah, I mean, they're constantly changing. What can we go after? I think sales tax like 25 to 30% of the revenue on average for every state. So they're just looking to call.
You're wrong. They show up, right? No presumption. Let's do the next kind of 5-10 minutes talking about M&A outlook, legislative updates. As I think we're all aware of now, the M&A market's white hot the last 6 to 8 months, and we continue to see that moving into at least the first half of 2022. Private equity firms in general, flush with cash, a lot of dry powder in the market. Just the amount of cash that kind of fiscal policy living under last year, and then also low interest rates. So that's all kind of combining together. We're 4 weeks out, firm and doing deals. The deal needs to happen by year end. We're not working on it. We're just capacity constraints. Actually getting proposed. I think the M&A markets continue to stay hot. What's a little bit unique of that this coming year is the monetary policy or the props that the government has been providing companies that are struggling are starting to roll back. The employee retention credit, PPP loans, other credits and funding, those are all being pulled back. I think even this week, 60% of bond purchases are done by the Fed, and that's now starting to pull back. So they're pulling cash out of the market because of inflationary pressures, and then these other programs are winding down. There was a low point in bankruptcy filings the last couple of years, and we feel like that's just the hand down the curve. And we see that again because next year will be led by the global markets, and global bankruptcies will be ahead of the U.S. because of how U.S. government supports these companies in time period. So look at that as a benchmark. Talking earlier, the CEO of Deloitte calls the next 3 years the golden era of consulting. So in the consulting business, it's because the combination, typically you don't have M&A activity. Same year you have restructuring activity. They're at different points in the curve, and now they're all occurring at once, which is kind of behind. So interesting dynamics that we see. Economic outlook, GDP shrinking in 22. Inflation, interesting. I pulled this from the Kipling letter. I've been following, tracking that, Wall Street Journal and others. I think that's probably optimistic that we get back to 0.8 at the end of 2022. This week, the Fed and the administration are talking about transitory inflation. I think it's here for a while. Again, I mentioned the monetary policy, federal government pouring cash into the country, into the economy. That's slowing down. So we've got cash chasing goods or inflation with the supply chain issues. So all that being said, I think we're going to see this type of inflation. Unemployment improving slightly. Also talking earlier, a lot of this work going on. We are just now kind of getting back to net neutral on hiring. We've been really working to replace those who are leaving. Not sure where they're going, and then now we're being creative on the hiring. It's taken the better part of 8 to 9 months to get kind of to that point where we're not replacing across the board in every industry. So look for that. I think, and that's starting to slow down. Midwest survey, the Kansas City Fed, the Kansas City issues a index survey. This came out a couple of weeks ago. That covered the 10th circuit, includes Colorado, the Midwestern states. They have a similar story. They're still expanding. Anything in the survey on the composite index north of 0 is expansion indicator. It's just slowed down just a little bit. And as I mentioned earlier, now 60% still significant growth, maybe slightly. Global supply chain from the news. We're all familiar with what's going on in other places, but the Asian industries, factories back online. COVID restrictions, so supply is increasing, and at some point now, but we are seeing some improvement in supply chain. Ships are so, but that's going to be a next slide. Talk a little bit about the Build Back Better Act. Congress recesses next week, and they have a impending shutdown occurring tomorrow. They have debt limit that has to increase by December 15th. They still have to get to this, and so I think the moral of the story is this is not likely to pass this year. Where current sits today, in terms of the provisions in it, the number one, probably the biggest issue, tax book income at 15% change, and significant change, and applies to a company over $1 billion. There are some legislative issues around that, some where it may end up having to change treaties, income tax protocol, require a whole completely congressional action. There are procedural issues that I think that are around that, not to mention just monetary policy. Other big reason why I think this is destined to survive until the next year is there's a budget shortfall reconciliation bills have to be paid for, and they only have to deal with budget. There's several provisions in here dealing with Southern Border Immigration Reform and Policy that there's a procedural, theoretically procedural violation. But the gap is about $360 billion between what it costs and what the revenue that's supported is Senator Manchin's main point of contention, along with the 4-week Family Leave Act. And he's sitting on a 60% approval rating in West Virginia. And you just saw what happened in Virginia. So I think he feels pretty important not to make a move. By taking out the Family Medical Leave Act, that saves about $200 billion. The difference between the White House view of the revenue and the gap and budget office is all around the IRS enforcement. They feel like the IRS, increasing IRS enforcement is going to raise the difference in revenue. The Congressional Budget Office says it's about $200 billion. So between the Family Medical Leave Act coming out, some agreement around the IRS, they may get to neutral, but watch what Manchin has to say over the next couple of weeks. And Sinema, to some degree, she was placated with the changes in the corporate income tax rate that was supposed to go up 28%, 25%. Capital gains rates are supposed to go up. That has been all pulled out. The current bill that's going over to the Senate. So that was one of her big sticking points. So they're out. As you know, the Senate split 50 right now. Vice President Harris as a tiebreaker. They lose one senator. The key parties to keep an eye on. A couple others, probably less important. The bill came over increasing the cap on state taxes. You can deduct it on your return from $10,000 to current limit to $80,000. Senator Sanders used that as a tip of the cap to the wealth, and he firmly did that. So what happens around that purpose? There's enough going on in Congress. They have enough issues. The Republicans are playing kind of hardball around the debt limit right now, and the longer that goes, the less likely. Don't expect much from that. Next slide. Just talk a little bit about what's going on in Colorado around income taxes. Big law change back in January when congressional legislature recessed here at Colorado. The big piece of that, you have about $450 million in new tax revenue, funding about $230 million in credits. The two biggest of those are your earned income credit and your child tax credit. The child tax credit has never been funded. This funds the child tax credit program in Colorado. The earned income credit was limited to 10% of the federal. I think it's been raised to 25%. Most of the revenue programs. Some of the law changes that are getting you there, you have to include in your combined unitary state filing if you have entities and think of like vacation countries, Barbados, Bermuda, Bahamas, Cyprus. If you have foreign operations in those countries, they're going to make you bring whatever revenue is in there into the state. The other one that is significant, moving from a Joyce state to a Finnegan state. That's two cases came out of California around state income tax apportionment. And I won't get into the details, but basically it's broadening the net of state tax. What gets captured from sales into Colorado from companies that don't have presence here, but may have a brother or sister company that does. All of that income gets sold into the numerator in your sales. A big piece of that, and I just throw this in 50%. Other small deals, 50%. The other big change,
you're right, and that was before that. It was fully. It was all meals entertainment, then it got taken away. Then
and then another change. Reid touched on this earlier about sales tax. Sales tax is generally attached. It's not to services, property. It's not intangible personal property. So they don't tax service, don't tax intangible property. What the legislature has done is expanded the definition of digital goods to include streaming services, things of that nature, very services related. They said these now into the property, so therefore we can, because we said they were. So another big change for this.
Tweak the definition.
Your point earlier, that states are kind of not even wayfair. They're just defining what they tax. Then lastly, we'll get to, going to give you an update on bill that did pass, the infrastructure bill. 1.2 trillion allocated kind of along these lines on a federal level. The federal government is giving the states revenue based typically on a per capita basis is how they figured this out. I'll tell you that Colorado is the 21st most populous state. They got 25th amount of money for whatever reason. They cut short a bit. But you can kind of see how it's being spent on a broad level. But in Colorado, they're allotment 6.2 trillion, 3.7 billion for highways, 9.117 transit, 430 airport funding, bus terminal maybe, maybe some new runways. The other thing, as I mentioned earlier, the termination of the PRC. It was set to sunset in December. They accelerated into September. So if you haven't taken advantage of refund opportunities around the employer credit, there are firms that you don't do this work. Firms that are going back, finding a million employment returns, substantial amounts, are really digging into the employment. Ways to look at that. That's not overly aggressive at all. Math, but how they factor in what your employment levels were in 2019 and what you paid, it can be pretty lucrative. So it's sunset in September. The statute's still open for refunds. Now, the only real tax piece. We don't. Any questions?
Can you go back a couple slides? I just had one question. So capital gains is being pushed. Right? That was such a big piece of driving a lot of this volume transaction perspective to do it 2021, especially with sponsor back. And so that's been potentially beyond 2000 or 2022.
Yeah, it's completely out of any legislation that's moving through the system. As is the other piece of the infrastructure bill that's pretty interesting is back during the Trump administration, but they codified the one decision rule, which they're trying to accelerate the time it takes from permit to shovel, which typically took 10 years in the past to a 2-year window to accelerate some of the infrastructure growth and development. So I think it's a critical piece of this, or a lot of things will take place for years because of the bureaucracy. So they have enacted decision rule. Yeah, we were talking earlier about whether or not that capital gains, some discussion from a constitutional standpoint, whether or not the announcement of a capital gains rate change which occurred in April could they make it retroactive. But it was impending, so I think a lot of people were trying to get their deals in. We felt pushing the big tailwind behind M&A activity. Well, that's been out of the bill now for a couple months. And we're still seeing that was certain.
Unrealized gain, gone. Is this
Yeah.
Didn't apply to me.
Yeah. Yeah, I'll take it.
Yeah.
Well, thank you for your time. I hope this is helpful and insightful. We can make the deck available, right, send it out. If you have any questions, feel free to contact Reid or local resource. I'm just happy to help anyone. Yeah. There's a lot of-
Happy to answer